Okay, so welcome everyone to our first episode of Yotewo podcast. This is the very first episode that we do, and today we're honored to have two guests, Alan and Michael, investment managers from Symvan Capital, one of the venture capital firms in London. Guys, thank you so much for coming. First of all, it's our first episode, so your support is very appreciated.
We're honored.
I think let's start with a brief introduction. Just tell guys about how did you enter the journey of venture firms, venture life, and maybe tell a bit about Symvan in terms of what kind of founders you guys usually back, what kind of startups, maybe a couple words on that.
Yeah, sure, I can go first. So I actually was very lucky. I was like a lot of other people, had no idea what to do after graduation. Mm-hmm. So I was looking for jobs essentially, and didn't know VC is a viable career path. Yeah. So very luckily, I got an interview with Symvan, and they were looking for some help with their operational stuff. So I just feel like I can offer a pair of hands. So I was kind of brought to do a bit more operational stuff, and then gradually they brought me into deals, DD, and make investments. So yeah, it's fairly straightforward. I didn't know what to do, and ended up with Symvan. So it's been a journey of 5 years.
Oh. That's amazing. What was your bachelor's or master's in? Like, what was the background?
Yeah, I was doing my master's in finance economics. I did my bachelor in economics, the usual kind of boring degree. Yeah. So I didn't want to go to investment banking, didn't want to go to consulting. I was quite entrepreneurial, myself. So I was kind of looking to start my startups, but I had no idea how to do a startup. So I thought I'd just go have a look at those amazing founders and how they started the journey from the beginning.
That's cool. Nice. Interesting. What about you, Michael?
There's some similarity there. Yeah. In that I was also thinking originally that I was going to come into this via the founder route. But if I go back a little bit further, I mean, not all the way back, but with my bachelor's was in English, which I thought was going to leave my options open after uni, but that was a decision I made before the financial crisis. So it didn't turn out quite as well as I thought. Yeah. I ended up then going to law school. I trained as a barrister, but really quite quickly realized it wasn't a good fit for me. It wasn't what I was expecting. And to be honest with you, I was kind of quite unhappy fairly quickly. Yeah. So I was looking for something really very different to that. And an area of law that I considered practicing was technology law, because I thought it was quite dynamic and forward-looking. And I ended up thinking maybe that technology is a good place to focus. Yeah. I got put in touch with a founder of an ed tech company. We hit it off, and he sort of said, you should come in and help me out on a project. And that was the kind of light bulb moment for me. And that's when I, like Alan, I was looking for more work directly with startups, maybe going down the founder route myself. I got put in touch with Symvan, again, started as an intern, thinking good bit of work experience, maybe see what the people with the money are looking for if I want to go down the founder route. And that was 9.5 years ago, and I'm still here.
Oh, nice. It's very interesting that a lot of people that go to VC, they have this entrepreneurial kind of like nature in themselves. Because when I was finishing my bachelor's and I was like thinking of whether to go in master's or do something else, for me it was the only like either choice to go found some startup or VC as well. Because I don't know, but it's very different from other finance jobs, and it's closely related to startups. It's interesting that a lot of people have pretty entrepreneurial nature in them, the ones who go to VCs. Okay, that's pretty interesting. I didn't know about the barrister thing. It's a very complicated job. I didn't expect it.
It was a brief couple of years in my life.
Okay. That was it. So that's interesting to know. Okay, guys, I'll start with one question that I think a lot of startup founders ask. What is this one thing that startups must do to capture your attention while pitching? Like, what is that one thing or a few things that you think are important? You want to go first?
Yeah, it's tricky. In terms of first impressions, I think for me, one of the things that always makes people stand out is conviction and clarity of purpose and clarity of the framing of the proposition. Mm-hmm. It always stands out to me when I see a founder or a founding team, or even just a pitch deck. It doesn't even need to be in person, and it shows that they've thought about what it is that they want to do, and they've very clearly define that problem statement and the solution, and they convey that with conviction. That always makes me sit up and take notice. I think I lose interest or lose focus when it's kind of woolly and it's sort of wrapped up in a lot of words, but not really conveying anything with any clarity.
Yeah, 100% agree. So I think to me, it's about being authentic. So it's about a human being talking to a human being.
Yeah.
So for early stage startup, a lot of things you're figuring out. You don't know a lot of things.
True.
As a matter of fact, as an investor, we don't know a lot of things.
Yeah.
So I think what's important is to be upfront about what you don't know and what kind of help you require, rather than just selling your startup, selling your vision, which is very important.
Yeah.
But more important is to see being an authentic person and being able to ask help when you need them.
Yeah, that's interesting. Do you think that applies to the founder only and the founding team, or like all team that is out there, or mainly on like the passion of a main founder? Or like?
Well, usually we talk to the funding team initially, especially stage where investing is really early stage. So usually just 2 or 3 co-founding teams.
Yeah.
So we do see some complementary skill set within the funding team and how they gel together as a team. Yeah. And also I want to see some humility in the founders and being open-minded about others' ideas and not just dictating the whole conversation.
Yeah, that's interesting. Yeah, it's very interesting because a lot of founders they I think they miss on that like point of being authentic, and they try to come with like big numbers, with like big concepts. I don't know, some flashy titles on the pitch decks. That's not really what investors are looking for.
A lot of them they want to impress the investors, like showing the big numbers, but investors probably I'm quite skeptical a lot of times because it's quite a lot of pitch decks, and even though we are pretty entrepreneur, but oftentimes we'll see what are the risks in this venture, and it's venture capital by its nature it's very high risky.
Yeah.
So oftentimes we'll say, oh, maybe that doesn't make sense, and why you are making that figure up. So just be forthright and direct with the number and your idea.
Yeah.
And we will make up our minds about the potential.
Yeah.
If you're just covering things up and saying things that's not really true, then that's an instant red flag to the investors.
Of course. Yeah, for sure. And it will be definitely seen on the due diligence, because a lot of startups, they kind of like think that inflating numbers and inflating their like traction is a bit okay, but obviously it's going to be clear during the due diligence. That's interesting. How many pitch decks do you guys receive per month on average?
well, quite a lot. I think it kind of fluctuates over months to months, but on average we receive about, I think, 2,000 decks a year, not a month.
Yeah.
But more often than not, we actively look for opportunities. We go to events, we speak to founders. Yeah. But organically, we receive about 2,000. That's quite a lot to review. Yeah. And that's really kind of consuming part. So that means we can't really put enough time on one pitch deck.
Of course.
So really to show you how you can deliver idea in a succinct way. Yeah. And come across kind of as both ambitious, but also just a bit of clarity. Yeah. Explain your idea in a easy to understand way. It's very important in your pitch deck, because investors don't have a lot of time to read through the tons of text in your pitch deck. Just clarity and kind of make it compelling. It's very important.
Yeah, that's true. Michael, what would you say?
Yeah, no, I'd agree with that. Not only do we have, we see a lot of stuff, but I think one of the things that's quite frustrating sometimes is how little, not effort, that's not fair maybe, but how little homework people have done before sending a pitch deck in, right? You could spend 30 seconds on our website and you'd have a clear picture, roughly at least, of what it is that we invest in, the stage, the sectors, the verticals. It doesn't stop people just bunging stuff in and not having done that work.
True. And
the number of times I get stuff into my own inbox, so someone's actually found my email address, they've not put it into sort of deal flow at Symvan Capital or whatever, but it's dear Symvan team or something, and immediately it's just a spam email. They've sent it out to God knows how many hundreds of VCs, and you just think, straight away, I'm not convinced that you're really that invested in bringing us on board as an investor.
Yeah.
I think that's
That's interesting. Yeah.
I think quality over quantity
True.
is better, even from a founder's perspective.
Yeah.
If you're going out there, I would always do a bit more homework, target a smaller section that you really think are a good fit for you and that you're a good fit for them, and personalize it a little bit. And I think your hit rate will be much, much higher.
Yeah, I 100% agree on that, like 100%, because a lot of founders, they like when I'm at the events or something, they come to me and ask like, there are so many VCs, like which ones do I target? I send like massive emails, get no responses, and I always tell them that you have so many categories, how you can like break down your startup by like your business model, your like I don't know, industry, your background, like whatever there is, and when you actually niche it down, there are not that many funds that will be like, it will be less amount of funds, but they will be like really, really suitable one with higher chance of investing in you. And that's 100% like what I always also suggest to people. That actually comes to the second question that we have. A lot of founders, they have a question, okay, I know what VCs are likely to invest in terms of like their memorandum or their approach. How do they approach the VC? Because obviously a lot of founders, they have this problem, that they apply on a website, don't get responses, I don't know, message on LinkedIn, and that's understandable with especially this volume of pitch decks. So what are the best ways to reach out? I always suggest people like try events. Events is a good type to connect, and also introductions, but maybe you can give a bit more like practical stuff on how to do that.
Yeah, I think that's spot on. I would absolutely say those things. Yeah. On top of what I already mentioned about just, doing a bit of homework. I'm not saying that you're going to spend hours and hours and hours. If you're a founder, we know you've got a million and one other things to be doing as well and trying to juggle. But spending a bit of time to actually find the right people in the first place is good. Yeah. I think you're right about introductions. The thing that I would say, because in and of itself, that's actually a bit, where do you start with that?
Yeah.
I think that the first place to start is that VC's portfolio companies.
True.
Because not only are they going to be a really good way in, but they'll also give you a really good impression of, don't go near those. We've had a nightmare working with them, or no, they're fantastic, or they're great, but you're not a good fit. So it's more than just a warm lead going through that. And we know from our experience, a lot of good pipeline comes through our existing portfolio, and it's kind of a win-win anyway, because there are plenty of good founder communities, founder, messaging groups and events and networking, and it's a really good community around it in London especially, but all over the place, quite frankly. People are always looking to connect like that, so you should already be doing that kind of thing anyway.
Yeah.
So if you're just trying to find the people who are in the portfolios of the VCs that you're targeting, I think that's a really good approach to take.
Yeah, that's true. Yeah.
Yeah, I mean, I 100% agree. But that's also a very time-consuming process.
Exactly.
Trying to find a list of VCs that's your stage and trying to understand the thesis and trying to look at their portfolio companies and also to find time to speak to them. It's great. You can do maybe 1, 2, 3 of those cases, but you can't really do that for every single fund that's out there, right? So I think when we acknowledge that not everyone has equal access to network. Maybe you are overseas founder, you're from minority, you're not really in that network. And historically, I would say VC has been quite exclusive in the sense that it's very network driven in terms of deal sourcing. Yeah. So I think when we're trying to be more fairer to all kinds of funders, all kinds of channels. So we also want to be very proactive in identifying those good funders that within those communities, but also we treat those cold inbound email fairly, as long as you've done some decent homework on Symvan, you're authentic, you're passionate about what you're trying to do, then we take a chance on looking at you. We not only look at those people that we know or from the same school or from the same background or from we're trying to be as diverse as possible because inherently people have an inherent preference of people who are like you, and I can see that's manifested in VC quite a lot. So that means there's a lot of minority funders or female funders not getting funded. That's a really huge issue in VC. So as early stage investors, we feel we have a responsibility to widen the pool and be proactive in identifying those talents, those great founders who are left out by the mainstream.
Yeah, that's perfect. That's amazing. Yeah, I would also love to add that for founders that are watching, it's very important to do your homework on very specific details on the fund, like whether the fund is currently deploying, have they invested in someone similar in the field. It's interesting, when we started raising, we got an introduction to one guy who owns a VC in States, and they invested in our competitors like a few years back. And we met with him for coffee in London as well, and I knew that he would not invest in us, obviously, because he invested in a competitor, but it gave so much useful advice. So it's important to take those things into consideration, like whether the fund is deploying, whether they have any competitors, how many investments they had recently, and all those stuff. But that's pretty useful. Thank you.
Can I just add one thing? I guess unfortunately, that fundraising need always to be part of the job of a founder. There's no escape with that. And whether you like it or not, if you want to build a venture scale and backed business, that's part of your day-to-day, is to make sure you can raise enough money to ensure the survival of the company.
Yeah.
Because your employees rely on those funding, especially you have a large R&D expenditure and the revenue coming later.
True.
And we're hearing a lot of founders saying that let's just raise in one go and then we can relax. No, that's not the case, right? You have to always engage with the VC community and also to fundraise. I mean, sometimes this can be quite boring, time consuming. I know VCs are quite annoying bunch of people, but I think unfortunately that's at least for the minute you have to. That's a skill set you have to have, and if you don't like it, talk to people and try to pick that up.
And always good to be thinking ahead as well. You know, identifying later stage funds. Going to them, not expecting them to write you a £200,000 check when you know that they only do upwards of 3 million, but reaching out and saying, look, we want to put ourselves on your radar. We know this is what you do. We want to let you know that we exist because we'll be knocking on your door in a year or two's time. I think a lot of VCs really appreciate that.
Yeah, that's true.
One red flag, just sorry, Chad, is we're seeing a lot of funders being very hands-off when they come to fundraising. They delegate to a third kind of financial advisory firm to their fundraising, even for pre-seed.
Yeah,
I think that's a mistake,
Yeah.
to be honest, because from our perspective, that's your job to fundraise. You're the best seller of your vision.
Yeah.
How can you hand that over to a financial advisory firm when you get started? So if we get approached by a financial advisory, we'll think, okay, what's the reason for that, and why the funder can't sell by himself or herself?
Yeah.
Like for later stage, that makes sense, but for the early stage, I think the funder needs to spearhead the fundraising.
Yeah, no, that's a very great example. Yeah, a lot of founders, I think quite a lot of founders use it, and I'm always trying to explain that fundraising is not only, first of all, it's a full-time job. Like you do it full time, and the second thing is that it kind of like shapes where you at the journey, because when you just start, you don't really have a clear idea, but when you do like go through the fundraising, it shapes like, okay, what are the actual costs that I'll have, what are the actual budget that I can rely on, and all those things. So it's really important. And also I 100% agree, like also after like being hands off after you raise, because a lot of like for me, for instance, like what I understood from the very first point when we closed the deal is that, okay, so now we have time to set up the system that should work, that should be like automatically, generating what we need to achieve, and I go fundraise again. So it's like it's a very short term thing that you need to do and raise again. So I 100% agree on that. Okay, great. Let's switch to the next one, to the Symvan itself. Maybe can you share? Well, first of all, Symvan is one of the oldest VCs in London. They operate since 2013, I believe. I mean, specifically CIS, one of the oldest CIS funds. Can you share a bit of like, just very briefly, sort of the origins of the fund, like how it started, like very, very briefly, and what's the specifics about the SEIS, EIS? Because apparently not all people understand it, and especially from outside of the UK. So maybe if you could share a bit on that.
For sure. So yeah, SEIS, EIS, Seed Enterprise Investment Scheme and Enterprise Investment Scheme, they're government-backed initiatives which basically offer really very generous tax reliefs to investors for investing in very early stage companies.
Yeah.
SEIS has been around since 2012, I think it was, something like that. And so you're right, we were one of the first SEIS funds in the country. EIS has been around a little bit longer. It was brought in under the John Major government, so going back away, and we're certainly not one of the oldest EIS fund managers. There have been some people right from the beginning there. And really it was kind of an initiative to kind of bring a venture industry to the UK, because before then it had been basically confined to California. And it's been, in many respects, a great success because it has helped fund an awful lot of businesses and encourage entrepreneurship and created jobs, etc., etc. So those are the schemes. And as far as I'm aware, there's nothing as generous as either scheme anywhere else in the world. I think there are some incentive schemes in Israel, but they're not like this. So it does make the UK a really attractive place to set up a business and look for funding, albeit we're still struggling in the UK with scale-ups and trying to avoid people jumping over to America once they hit a certain point of scale. But so that's SEIS and EIS in a nutshell. As far as Symvan is concerned, so we were founded in 2013 by our two co-founders, Keelan Doyle and Nick Nicolaides. They'd been working together for quite a while before. They'd previously done corporate finance advisory work through Symvan Securities, which they'd set up. Before that, they worked at an AIM broker, and before that, they both had pretty illustrious careers in investment banking, larger scale M&A, and they worked their way earlier and earlier in the life cycle from these big IPOs that they were working on through AIM brokerage and single stock EIS, and then they said, well, let's set up some funds, let's take a portfolio approach, and they set up the first SEIS fund in 2014, which was really kind of a toe in the water, to be honest. It was a very small fund just to sort of test the theory, and then in 15-16 we had our second SEIS fund, and our EIS fund launched. We're now onto our third SEIS fund, and the EIS fund is evergreen. We've been going for over 10 years now.
Cool.
I've been around for quite a lot of that, 9.5 years worth of that.
Didn't know.
So that's the brief background. And maybe one other bit of detail on that is that from the start, we've always been focused on technology investments and growth technology. There was a time when most of the EIS market was dominated by what was called asset-backed investments. So there was a lot of focus for a while on things like solar plants and anaerobic digestion plants, and the idea was very much it was a tax planning play, not much upside on the investment, but tried to lower the risk as much as possible. And Symvan have always been much more sort of what we think is more the spirit of SEIS and EIS, and that's the way the government has now moved it, I think rightly, much more to higher risk, proper kind of growth companies, trying to get businesses off the ground and encourage that investment, not because it's a nice tasty tax break, but because it gives fuel to the economy, which right at the moment is absolutely something we're crying out for.
That's true. I think anything.
I think SES. That was 2012 was still doing my high school, so I couldn't comment much on that. But I felt that really SES really kickstart the early stage kind of investing, which enable a lot of people to get started, which is very important because historically a lot of focus has been those scale ups. Only if you hit 1 million ARR, let's come to us, but there's a lack of funding for that really early stage for institutional investors. So I think SES really opened the door for early stage investing with that generous tax relief that enables those kind of early stage startups to get funding. So I think Symvan is different in the sense that we really want to or we like to go into really early.
Yeah.
And even if you don't have any revenue, if just have an MVP, we want to have a conversation with the founders and to see what kind of support and kind of help we can provide as a VC investor. Sometimes the startup journey can be really lonely, so you want a partner early on who understand what's the pitfalls of early stage startup, and also can provide some value and support at that early stage. But also it's for us to see how we are getting along with that SEIS. We are saying about life cycle approach is that we don't really only stay at SEIS.
Yeah.
We only invest in 4 to 6 companies a year. The reason being is that we want to come in really early and work with you and being very hands-on.
Yeah.
And then to hopefully get you to a stage where you get some revenue, start seeing some product market fit. And then we follow on with the EIS fund or fund you a third-party investor to do the seed round.
Yeah.
So that's what we call a kind of life cycle. We just don't stop at SEIS. We also have EIS fund to primarily follow on with the more successful graduates from the SEIS fund.
That's perfect. That's great. It actually very comes to my next question, but I also just wanted to comment about the SEIS thing that I was really surprised that I think I read the stats that there are 16,000 startups applying for it every year. And like it's such a strong initiative that it formed like another industry, which are like platforms that automate like applications for SEIS. They're one of our new partners. They're doing that. They're like made an AI that automates the applications for SEIS and like I don't know Seed Legals and all those companies. It's like it created like a huge like niche but still like big industry. So it's it's a very impactful thing. About the next question. So my next question is on the fact that a lot of founders they are very cautious of going to VCs because in their mind it's like super strict guys who are coming in very strict with their rules, and that's why they choose angels over VCs. When we started our journey, we had a chat with few angels and we saw like the total disconnect with them because our industry is, it's like recruitment doesn't sound too sexy, sounds like pretty cold. And I think angels, they mostly like invest based on their emotional connection to the company or something like that. When about VCs, it's more on the economical level, whether the numbers make sense, whether the founder makes sense, whether they can execute and all those things. And I know that like Symvan, it follows rather advisory path than like this stricting path. What would you say like practically like it benefits founders? Obviously, I can say that. Maybe you can share like your view on that. Like, why is it better?
Look, I mean, we think it's probably a little bit better, but I don't think there is like one right way of doing it, right?
Okay.
We say this to founders quite often. That when we're in those very early conversations before investing, it's got to be right for you. If you are a founder that doesn't want that support for whatever reason, like I say, I mean, who doesn't benefit from support? I would say, but if that's not what you want, if you just want someone to cut you a check and let you do what it is that you want to do, you've got a plan for it, and you don't think you want that kind of hassle. Then fine. There are going to be investors out there who can help you with that. And that's not to say that those investors are just sort of negligent or whatever, right? It's just a different approach. I think where we come at it from is that it's tough. It's never kind of smooth sailing. I think there's a problem in the industry with quite persistent narratives based on like a small handful of these compelling stories of wild success, and Europe's fastest growing startup or whatever, the quickest to become unicorn or whatever it is, and those stories they capture our attention and they stick in our minds, and I think that can be a bit of a problem because it makes people think that that's what being an entrepreneur is, and I hate to break it to anyone who thinks it, but like most of the time it's really not like that. It's very hard. There are a lot of problems that you encounter along the way. Even if there aren't lots of problems, it's just very demanding of your time, of your emotional investment as a founder, because you can't really switch off. The buck stops with you. So where we come at it from, I think, is that it works best for us when our founders in our portfolio companies feel confident and they feel comfortable to come to us with whatever, to be honest with you.
Yeah.
Whether that's I've got something on my mind, or can I run this idea by you? We might have an opportunity in such and such, but it would be a bit of a pivot. Or, guys, I think we've got a big problem because X, Y, and Z. I'm not getting on with my co-founders. Whatever it is, it works better when it's like an open dialogue like that. And like Alan said before, a bit of humility from founders, acknowledging that I don't know everything.
Yeah.
However experienced you are, however brilliant you are at whatever it is you do, you're not going to be brilliant at absolutely everything, and there's going to be stuff that you don't know. So why not lean on whoever you have around you? And so, like, as much as possible, what we try and do is be as available for that as possible. Like Alan said, keeping the portfolio small so that we're not stretched too thin on that.
Yeah.
We know all of our companies well, intimately, what's going on when things are starting to look like they're maybe not going so well, and are there to pitch in, roll up our sleeves, and kind of just be another pair of hands to help you out with what it is. Because that's the other thing, at these early stages especially, it's messy. As a founder, you're juggling loads of different responsibilities. You're not just in and you've got a couple of other co-founders, especially if you're a sole founder.
Yeah, that's crazy.
You're juggling so many different responsibilities. It's hard, it's very demanding.
Yeah,
so
that's true.
Yeah, I have to say, VC money is just one of the options, many options you can have. And it may not necessarily be the best option for all the funders.
True.
I think there is a misconception about VC money. Okay, if you get VC money, you're better.
Yeah.
I think that's a huge misconception.
Yeah,
definitely.
I think as a founder, you need to think about what's the right funding option for you. So the way to do it is to start understand what are the differences and similarities between different funding options.
Yeah.
The clear two routes is whether you go for angel, go for VC, or you can go bootstrapped.
Yeah.
You can skip the pre-seed and go to raise seed round.
Yeah.
I think the benefit of having VC money is sometimes it gives you the credibility early on when you make your enterprise sales.
That's true.
And you can get the view from the VC who experience with other startups, know the common pitfalls of early stage kind of journey. I think sometimes can be very useful. But personally, I think it's overrated for the Netherlands. And as a VC, I have to admit. So really, I guess it's to give you that kind of professionalism and to give you some advice and support, but that doesn't mean it's necessarily right for you or we are the best investor for you in your sector.
Yeah.
You may find you can better off getting some super angels who are the leaders in your industry, can provide you more strategic advice and help.
Yeah.
And sometimes another aspect of choosing these, sometimes I think founders get the kind of the wrong end of stick is the valuation. Because sometimes VC as a professional investors, we tend to be very, very valuation driven and return driven.
Yeah.
So that means we can't sometimes match the valuation given by angels at pre-seed stage.
That's true.
Because they are sometimes driven by their emotion. They won't kind of be involved as an advisor.
Yeah.
So the problem with raising money from an angel at too high valuation means, because angels don't usually follow on, that means when you come to next raise, you have a lot to prove to get even a fat round or get valuation uplift.
Yeah.
That can bite you later down the line. So that's just something to be aware when you raise angel money, and then you can get a very high valuation, much higher valuation than what you can get from VC, which a lot of funders don't appreciate it until they really get to the next stage of fundraising.
That's true. Yeah, I 100% agree on the credibility as well. When in our case, because we partner a lot with like VCs and like those kind of stakeholders in the industry. And when we started reaching out to people with like starting like we are VC backed startup, it changed the whole thing. Like the response rates went up, and that's very important. And for those founders who think that VCs can't give you smart money, that's totally wrong. It's just about like getting the right investor, whether it's VC, whether it's angel. It can be both ways. So if it's a VC, it's not necessarily not smart money. 100%.
Yeah, that goes back to what we were saying about doing your homework when you approach VC, right?
Yeah.
Because at the end of the day, you want to have a what I call it investor funder fit.
Yeah.
To get the right investor. I think it's always a two-way process. It's not just VC picking startups. It's more about start picking VC, especially if you genuinely believe in your vision. You're not just doing a lifestyle business. You have an ambition for a startup.
Yeah.
You need to bring the right partner and right VC to your cap table.
And something we say quite often is that, especially if you're getting in at pre-seed level, this is a working relationship that might be 5, 6, 7, 10 years possibly.
Yeah.
Which we often hear is sort of longer than the average marriage these days. So you've got to be sure that you're able to work with these people, but like Alan says, both ways. It's imperative.
Yeah, no, 100%. I think if the VC is right, there will definitely be a support. I remember, I think it was a week ago, when I had something on my mind, I just dropped a message to Alan, like very late at night. I think it was like 10 or 11. Like I read something about our competitors and I had this idea in mind. So I just sent out the message to Alan, like very late. Alan responds. It's a very supportive thing. So it's really useful.
Yeah, we try to have a better work-life balance. But it's always very hard to try that balance as startups. But I have to say to those audience is well-being is very important. You can't, as a human, you can't work all the time. You can't ask your employee to work all the time. So how you can have a more efficient way of working, how to work smartly.
That's true.
It's very important to know where to put the effort and where to have relaxed and have built fun. I think having fun in life is also very important.
Yeah, of course.
But of course, a VC wants you to work very hard and to drive the return. But we're also conscious of we are all human beings and we're all in it to build something amazing. So we're in it together, and just don't stay up all night and doing things. Sometimes it's necessary when things needs to get done.
Of course.
But also remember to take care of yourself, and you have a family, you have a kids, and it's also important to spend time with them.
Yeah, that's great advice. Yeah. The next question is pretty general. What do you guys see like as a trends in the industry for the last couple of years? Like where on not on the investment side, on the startup side, like what kind of startups coming? Like what are you most excited about like the new upcoming generation of startups?
Well, last couple of years have been crazy. So I joined Symvan in 2019 when generative AI is not a thing. It was quite a lot of Web3 kind of stuff. And then all of a sudden COVID came in 2020. Then suddenly everyone is in a panic mood.
Yeah.
But then after government support, we feel the venture market start kind of bouncing back really quickly, and we're seeing a bit of bubble in the market because there's interest rates, and we have a lot of liquidity available for startups, and startups are growing at all costs, and valuation kind of it's very, very high. So as a VC, we found it's very hard to find value in the market in that kind of couple of years. Then suddenly inflation kind of creep up, and then market turned really quickly. So a lot of VCs and a lot of startups are quite unprepared in that new reality. So that's the general kind of market kind of backdrop. And now we are seeing a recovery as with the interest rates start coming down.
Yeah.
But in terms of the sectors, we are seeing a lot of so VC. There's quite a lot of FOMO, fear of missing out in this. So at one point we felt like there's this amazing opportunity at fintech. Sometimes we find it's just Web3 and then AI.
Yeah.
So, however, as a VC, we are looking at the long term. We're just not chasing what's the hottest startup in the city. So really, what I found what's happening with generative AI, definitely there were going to be a lot of great stuff coming up, but however, what we are saying at Symvan is no matter what kind of technology you use, end of the day is what is the problem you're trying to solve, and then what's the best technology, whether it's Web3 or AI, to use. Yeah. So we find a lot of funders become too hyped up with AI, with generative AI, and start using AI to do something that the market may not be ready for, or maybe it's too early, or the problem is just not best solved by AI. So we see a lot of AI pitch that's coming our way that's solving the wrong problems, or not solving the important problems in our view.
Yeah.
But however, I think I'm very optimistic about this new generation of funders and startups enabled by the amazing technologies, the LM, those foundation model we have.
Yeah.
It enables the non-technical founders to start tech businesses without necessarily having to have having a technical background or co-founders.
Yeah.
It really drastically lower the cost of starting a startup or
Yeah.
producing a prototype, and to start testing your idea early on without getting a lot of VC money, especially in this current market, which is quite tough to raise money. So I think it's really enabling technology, generative AI and AI in general, for a lot of founders, whether they have access to technology, whether they have access to network, to start building something, to realizing their ideas. So that's one very, very optimistic. But at the end of the day, as a VC, we want you to focus on the right questions and the right problem to solve. But now the question is, what is the right questions? What's the right problem?
Yeah.
So that's always the hard question to ask. And also as something as a VC we are working on all the time is to see what are the challenges in the market, and what kind of funders we should back, and I also have to admit that things we don't know and things we can get wrong. So I also have a bit of humility on the VC's part, and at the same time trying to learn as much as we can and talking to as many funders as possible. Trying to be just part of this ecosystem, which I'm very, very passionate about. As you can see.
Perfect. Michael, anything to add?
Look, I mean, it's not exactly a novel answer, but it's difficult to get away from AI being, like Alan says, there's a lot of hype around it and a lot of stuff that will fall away. But I think it's very difficult not to see it being a technology that fundamentally changes the way we live and work in a way that we haven't seen since the internet, basically. And I think much like the internet, I think we're in a similar kind of pattern of a big boom. There's a lot of hype, and I'm sure there will be a point at which that sort of falls away, and that will be be a graveyard of a lot of rubbish startups. But from that you'll probably have some like I say, these lasting massive companies, the likes of what happened post the .com crash. Companies like Amazon and Google really becoming these enormous entities that completely dominate our lives. I think there's a very strong case to say that that's what we might be seeing over the next few years with AI. In terms, the other thing that maybe I would add just very briefly is that I think because it has become a harder market, from those the sort of 2021 absolute frenzy of it just didn't matter, you just put your hand up in the air and say I'm a founder and someone would chuck some money at you. I think from that peak, because it's got a lot harder, I think one of the things that we're seeing is like a higher proportion of kind of serious founders, founders who have thought about it. It's not a lifestyle choice. It's not like, I've read a biography of these, snazzy Silicon Valley success stories, like I was saying before, and thinking, I think I could be a guru. I think I could be a mogul. It's more, because it has been difficult to start something and to get funding for it, and maybe you started at just the wrong time, and COVID made things really very difficult for you. So if you're still here and you're still standing and you're still saying, no, I want to do this, as hard as it is, I think there's a lot of people a higher proportion of people that we're seeing that they're here for the right reasons, and they're kind of ready to tough it out, and that counts for a lot, I think.
That's very interesting. Yeah, 100% agree with the impact of AI. Even, in our industry, like I think OpenAI is kind of like more or less like in terms of the use equal to Google among like people that would be usually our clients. We see that a lot of people, they are, instead of going and Googling like where to get developers, they actually go to ChatGPT, ask what is the best like developers platform in London or stuff like that. So it definitely dominates the Google search in terms of like our industry, for instance, for sure. And I also see the this tendency. I wanted to share, like, to ask your opinion on that. I see that because of like recently, the time towards exit shortened in relation to like before, because I just like like look at a lot of startups, like just I don't know, for any software that I need to use, and I go to their websites, and I know these are pretty new, like I don't know, 1, 2, 3 years old, and I always see this like banner in front of their on top of their website, like, oh, we've been recently bought by, I don't know, some competitor in US, and it gives me a feeling that the number of like the timeline towards exit shortened. Would you say that's the case or not really?
Well, we are actually seeing, because of COVID, that timeline has kind of flattened a little bit because there's lack of kind of funding available to acquire companies, and a lack of opportunity for them to grow to a stage where they can be sold. So there's a lot of liquidity problem within the VC of returning the funds back to the investors. Okay. But however, we're seeing quite a lot of US investors in recent days to buy on the cheap. Okay. The European startups. We have great founders here. We have great talents here, but as Michael mentioned, we have a kind of scale up kind of problem funding gap. Yeah. So I think that's been to some extent been taken advantage of. And so a lot of really early stage companies that got bought out once they have a really smart tech or great funding team. So by buying either tech or talent rather than the customers. Yeah. So we are seeing a lot of kind of those buying opportunities, but not necessarily great for the ecosystem.
Yeah, of course. Yeah, interesting. Would you agree, Michael?
Yeah, I think so. I think it. It's difficult because a lot of that data is very difficult to interpret too much into unless you really dig into it. At what stage were these successful returns? Were they kind of fire sales? Was it at a down round? Yeah. Because I can see there being I wouldn't be surprised to see in those numbers quite a lot of consolidation plays, for example. Because, like Alan says, I think the market has been really desperate for liquidity for a little bit. And, I wouldn't be surprised. I'm kind of speculating here, but if there's some element of just trying to get stuff off your books as a fund to try and generate a bit of momentum, and even if it's not at a great valuation. Yeah, I mean, it'd be interesting to find out a little bit more, because I think, and it's also, I imagine as well that there's a part there that's informed by the fact that basically there's been no IPOs for like at all for a while. Generally, never mind in the UK. The UK's really, really struggling with that kind of thing. So it might be that people are looking for those avenues towards liquidity outside of what was there before, and what that means is that some of those are just happening earlier, but maybe they're not. Yeah, I don't know. It'd be really interesting to know.
Yeah, I find a lot of VCs, to some extent, kind of want to offload the position in startups, especially they came into the early stage back in 2021, and usually the VCs give startup a runway of about 12, 18, 24 months. Yeah. So as you can see now, it's 2024, 2025. It's a time when a lot of startups are nearing the end of their runway, but probably some of them have not reached their targets or have not been able to raise further funding. And when they end up their runway, there's kind of only just a few options available on the table. So I think a lot of VCs are looking at their portfolio companies, seeing the opportunity for them to do follow-on funding or get third-party investors, or for them to find a financial advisory firm to start selling the company. So I think that may play into kind of a fact that you're seeing that a lot of companies get sold. So it's really good to know whether they're sold at a premium or a haircut.
It's not necessarily a bad thing anyway, because you want a bit of movement in the market. You want success stories, and not to sound like a broken record, you don't want all those success stories to be unicorns and stuff. You can be a very successful founder and probably make quite a decent amount of money even for selling a company at 10-20 million pounds. That's if you still hold a decent chunk, that's a nice payday, and it's a good proof point. And it means that you can absolutely go back into another project and be able to say, I'm an exited founder.
Yeah.
I made money for my investors before.
True.
Yeah, people are going to be queuing up in a situation like that. So there's a way in which it stimulates the market anyway. You don't want it to just all be low level, of course, but I think it's not necessarily a bad thing.
Yeah. But the challenge with that is if the investor come in at high valuation and then they got sold at low valuation, then surely there will be some people will get hurt. The question is whether they value the money returned to them, or would they be a little bit more conservative and hesitant in redeploy the money back to the markets.
Yeah,
We're very interested to see how things are playing out. But I do think the incentive government give for SEIS, EIS creates a bit of a cushion in the sense that even though it's a lower exit multiple with tax benefit, generally it's still a good return.
Yeah.
So as long as it's not selling a huge haircut. So we are still waiting and seeing how market will pan out. But as Michael says, have some liquidity back to the market is a good thing. That means we can recycle the money, and then the funders, rather than get stuck in their startup, they can start a new venture.
Yeah.
So which is not necessarily a bad thing for the markets.
Yeah. Okay, interesting. Thank you. And next question is actually touching upon that a little bit. So the next one is, what would you say, like, the balance between, I mean, it's a pretty wide question, but what's your view on, like, traction versus vision in a startup? Because a lot of founders, surprisingly to me, they don't perceive startup as much as they don't see too much traditional business in a startup. They rather think about, like, their vision. Our concept is going to, like, take over the world. And the Symvan strategy is like life cycle approach, right? Which obviously is very clear, requires clear traction, clear revenue, not necessarily revenue, but like the clear traction, at least the clear going towards the right thing. So what's your view on that? Like, or maybe advice for founders, like, that kind of too much focused on the vision, or maybe vice versa?
Yeah. I'm inclined to say that they don't need to be in opposition necessarily. They're not mutually exclusive.
Yeah.
The way I would try and frame it maybe for founders is to say that your vision, that's one of the things we're buying into as VCs, especially at the early stages. We're buying into you as a founder and your vision and our belief that you can execute on it as much as anything else.
Yeah.
But that vision, I would say, necessarily when that vision has something useful about it, is when it's a vision of bringing something concrete into existence, right? It's not it's not. We're here to build businesses. We're here to create value fundamentally, right? Yeah. And that value is in a tangible sense in helping companies increase their efficiency, or providing consumers with a bit of it's not what we invest in, but whatever it might be.
Yeah.
It's not, I have a vision for a painting and then I'm going to bring that to life, or whatever. It's I have a vision for a business because I have a vision that there is a solution, like Alan said before, to a problem, and that's going to create value. I think it's important that people on all sides of the ecosystem kind of remember that the words value and valuation are similar for a reason, right? They should be in lockstep. If you're focused on building something that's useful, that has value to people, then the rest should follow. But so, I'd never want to say, to bring it back to your question, forget your vision, if you like. I just want to see some numbers. Yeah. But equally, I'd never say, you just keep dreaming whatever you want to dream. It's got to be a vision for something concrete and a vision of a plan to get you there. It goes back to that, I think, the first question you asked about what kind of makes an impression. Yeah. What we want to see as founders who it's not just like, oh, I've got a great idea for where this could be in 5 years' time. I've got a good plan of how to get there. Yeah. So I don't, sorry to kind of rip up your question, but I don't think it's necessarily a choice between the two. Okay. It's just making sure that because you need to have that vision as an entrepreneur. Otherwise, you wouldn't do it, right? You would just do a 9 to 5 or something.
Of course.
It's at the heart of entrepreneurship, but your job is to build something with value and to build it in real terms.
Yeah.
That's your job as a founder, in my view. So,
balance between both.
That's a really good point. Well, I think if you are a generative AI startup, the good news is that having a vision is probably enough. But I think the reality is it largely depends on the market. I think 2-3 years ago, you can raise a VC funding with just a vision, but now you need some more traction.
Yeah.
And also to show you can reach profitability. So now it's kind of market share versus profitability. So I totally agree with Michael was saying that this may not be two of the opposites. I think it depends on where you are in your journey.
Yeah.
And what I see is traction is a validation of your vision. And early stage is an early validation. Later stage is more validation of your hypothesis, your vision. And the vision is like your North Star that guides you where you want to go.
Exactly.
I mean, that can change, right? It can pivot, but that's kind of North Star. That will get everyone motivated and get everyone around you really excited about what we're trying to do. But you still need to have feet on the ground and to walk there, right? And as Michael said, having a plan and also to articulate that clearly and how you can get there with different milestones.
Yeah, exactly.
That's also very, very important. You can't just say, look, I will get there. But the problem is how will you get there? What kind of resources, what kind of funding, what kind of the things you require.
Yeah.
So it's kind of more step-by-step process. I would say it's more like scientific research.
Yeah.
You need to have a hypothesis. You need to have methodology to get to end goal. So that's all very important. So I would advise all startups to founders to get as much validation as possible early on to test the market and test your vision. And maybe just your own vision. Let's see if this is a vision that market needs and other people need. That's very important. It's not just your project. What you're trying to build have an impact on the society and have everyone around you. Yeah. To bring everyone around you, bring this world, this society around you. Yeah. And then see if that something was your sweat and your blood and soul to work on this for the next 5, 10, 20 years. And that's very important because that's the end of the day, that's motivation to keep you going. So that's very important for us to see the vision from the founder, especially from the founder. Yeah. But without losing sight of the traction and also to show whatever you can either it's revenue or customer engagement or conversation you've had or market research you've done to show that this is a viable vision to work for. Yeah. Worth spending time and money on. Yeah. That's also very important.
That's true. I really like the saying North Star. That's very well said. That's a good one. Okay, so we covered what would impress you as an investor. What would you say, very briefly, the top 3 red flags when in founders pitch to you? What are the things that you maybe in the founder or in the pitch itself that you would immediately probably not?
Yeah, I think something that is always a bit of a red flag is a founder who, I mean, it's going to sound very generic when I say it like this, but is not on top of their own product and their own market. It's fine to not know the answer to every question that we might ask you in a meeting. Yeah. That's absolutely fine. But it's always got to have a but after it, I don't know, but my CTO could tell you and I'll follow up afterwards. Or we don't know yet because we haven't had that customer feedback, but here is our plan for how we're going to do that and integrate it. Yeah. It goes back to that thing I said about kind of clarity of vision and doing your homework. If we're going to invest in a founder, I want to know that you've really thought about this. Yeah. And if there are holes in, when we're asking questions, again, especially at the early stage, there's going to be plenty you don't know, plenty you're still figuring out. But I want to at least know that you've thought about that. I don't want to, have looked at it for 20 minutes and I've asked you 5 questions and it's, actually, I've got quite a lot of holes in this proposition. That's always a red flag.
Yeah, that's a good one. What would you say? Maybe just one.
Yeah, I will try. I think first one I brought at the very beginning of this conversation is authenticity. I think it's very important for a fund to be authentic, so I can trust you. I can trust the investor's money to you. So if anything I find you're blowing things up and not telling kind of common sense, I think that's an instant red flag to me.
Okay.
Another thing is you only have a vision but no plan. I think that's also a big red flag because end of day we want to see how you're going to execute the plan.
Yeah.
Right? I think a poor idea executed poorly, well can be better than a good idea executed poorly.
Yeah.
And that's very important to bear in mind. I think the third point is that don't make it like a sales pitch.
Okay.
You should tell a story, and in your story you have a lot of twists and you have up and downs.
Yeah.
Don't only tell about the good things. Tell
That's true.
about what you need, not just the funding, what and support you need, and being truthful about where you are at this stage, and make it not so slick.
Yeah.
I think that's my advice, but also make it clear and succinct, so investor can understand what's going on in just a couple of minutes.
Cool.
So I think that's kind of 3 things.
That's interesting. Storytelling is important. Yeah, 100%. Okay, cool. Now my next question is about a little bit related to what we do, to recruitment. You guys meet a lot of founders. You see them at the very early stage, and you sort of with them as they grow. Our product solves the problem of like finding tech talents for the products, for the startups. Would you say it is a challenge for founders, and like maybe any practical like cases or examples where you had it in practice?
Yeah, it's definitely a challenge to find good and reliable developers, and also it's getting super expensive, so the cost is very high of hiring the wrong developer. And I think this is especially true for a lot of non-technical founders who do not have a technical CTO or co-founders, is that they have little knowledge about how to source for those developers and how to find an effective way to manage them, and how do you assess the quality of their work. So I think that's a real challenge for a lot of startups, and as a lot of the cost driver and kind of roadblock for them to execute quickly. Yeah. So definitely I can see that's, I guess that's part of the reason we invest in Yotewo, and we are seeing that as a challenge, but not only for startup, but also for enterprises as well, and for a much larger market. Yeah,
because we tend to, when we have new clients coming in, new startups, we always tend to ask like, okay guys, so why do you need us? Why did you decide to come here? And they like telling us stories, like what were their like pitfalls, whether they went to freelancers and they got all their code lost, or I don't know, they hired someone in overseas and the person just like, turned out to, keep the code and tell everyone to, pay them more or whatever. Or maybe like, I don't know, overpaid recruiters and didn't get the results. I don't know. So many cases. Did you had maybe anything like that from, I don't know, stories around?
Plenty. I think especially like Alan said, it's sort of knowing what you need that's important. And if you don't necessarily have that tech expertise in the founding team, then knowing what you need in the first place is quite difficult. And we've had plenty of examples of, companies that have hired people or outsourced development work, built, an entire version of a product, and then figured out, actually, we need to rebuild it from the ground up. It was built on the wrong framework or in the wrong language for what we need. And it wastes a lot of time and a lot of money. And as well as getting good talent, it's getting the right talent and having someone to kind of point you in the right direction is really, really important, because these mistakes can be really expensive.
Yeah, that's true. Yeah, we sometimes hear stories from the clients that they come to us and they tell us how much they spent on the product that they have. We see how many problems the product contains, and when they tell us like we spent, I don't know, 200 to 500,000 pounds on that, we are just surprised by that, because it is a huge industry, a huge problem, and if we've run the numbers, like it happens more often than it should be. Like it's crazy often. So, but it's interesting. Okay, I think just the last question, and we'll kind of wrap up. So, what do you predict? I mean, we had a chat a bit about that, but what do you predict will be the biggest shift in VC in the next 5 years? We see some funds doing AI-based investment now, like isn't like the AI that calculates whether the investment will be returning. So, what would you say on that? Yeah.
Well, it's always very hard to predict the future, but I will give a go. And I think, as with many other industries, I think VC hopefully will get democratized more and more with the emergence of generative AI. It was quite powerful. Symvan, we're thinking about how we can better leverage generative AI and AI, predictive AI in general, to better source and scale our operations. And also our research as well. So we do see a huge role of AI in VC. So that means not only those people who have the network can start VC. That means anyone who can provide value to startups, and that they want to start VC, and they can start working with a startup, and also to use AI to not hire quite a lot of people from the beginning, but just start very small. We're going to see a lot of micro VC or kind of angels becoming micro VC.
Interesting.
And if they're generally good. So I can definitely think there's going to be a bit of competition among VC for great startups. But I think fundamentally, VC is part of finance. I wouldn't necessarily say it's traditional finance, but those industries tend not to move very quickly. So 5 years is a very short period of time.
Yeah.
So I think fundamentally, it will not be disrupted from the core. But I do see VC will evolve to be more accessible for different funding groups, funders from different backgrounds. And it's also my wish, my hope that that we will be able to democratize access to VC, both for startup operators now wanting to become VC, but also for startups now looking for funding. So that fairer access to VC I'm optimistic will become more of a reality in the next couple of years, but also that requires effort from the VC community to come together to solve those kind of the perennial problems of underfunding for female funders and for minority funders. I think with the power of generative AI and making us more scalable, making us 10 times VC investors, if there's a will, I'm seeing a way to get there. So I'm very optimistic in the next 5 years and what's going to happen in VC.
That was so well said. That's very great. What do you think, Mike? Do you agree?
I'll try and stick on an optimistic, hopeful message, rather than talk about, I don't know, the fact that I think there's going to be a lot of failures still to come or something.
There are always both sides,
Well, I think one thing I would like to see over the next 5 years is kind of linked to Alan's point, I think. What I'd love to see is a bit more of a shift in the VC industry towards some more kind of contrarian investment approaches. I think, there's a lot of good being done in the industry, but I think there are some quite sort of rigid and dogmatic approaches to VC investing, some real kind of strict adherence to like power law principles, and like that's fine. It's okay. But I think the industry will benefit, and I hope that it will happen over the next few years, that there'll be a bit more diversity of approach as well, taking different kinds of investment theses out into the world, and ideally, trying to upend that a little bit. It'd be nice if VC wasn't built on the assumption that there's going to be loads of failures. There's always going to be failures,
Yeah.
but I don't like the idea that it's just there's a bunch of VCs who are all sort of saying, well, if 9 out of 10 fail, that's what we expect.
Yeah.
Anything else in the world, basically, a model that has 9 out of 10 failure, you'd say, well, that's not working very well. Let's try and fix it. Let's try and do better than that.
Yeah.
So it'd be nice to see a bit more of a rise of that rather than, it being dominated all by sort of high volume, low success rate, but capturing a few outliers. That being the dominant approach across the market.
Amazing. That sounds like a very, very good conclusion of the whole talk. Actually, I have so much food for thought now. It's been a lot of insightful topics. I'm sure it was extremely useful for people who are watching. Thank you so much, guys, for coming. I will mention you guys find all the Symvan links in the descriptions, all the links to Yotewo social media, and yeah, guys, again, thanks so much. Was really glad to have you here.
Thank
So
you.
it's very nice.
Thank you so much.
Fun.
Thank you so much.
Thank you.
Thank you, Mike.